Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our guests on the show. Joining us today are Shahina Mukadam, who is an independent market expert, Lancelot Cunha of ValueX Research, and Avinash Gorakshakar of Joindre Capital. Many thanks to all of my guests for joining me. On the show today, we discuss one of the recent stocks listings which have done well. So could be any of the stocks which have done well. So we speak about the recent IPOs. We ask our client which is the best city gas distribution company of late. We also discuss one beaten down stock that can be accumulated. And lastly, we discuss what's plaguing UPL. The numbers were extremely poor. Post that, what's the view on UPL? So those are the stocks that we'll discuss. But first, one stock which was recently listed. Initially, if you see a couple of companies, be it an Affle India, be it an India Mart, be it IRCTC, most of them have managed to give very, very strong returns post-listing. So we ask our guests, is there any of one of the recent IPOs that they like, and can they believe there could be more potential upside on any of those stocks? So Avinash, I'll start with you. Lots of names to discuss. In fact, it's only the recent IPOs which have managed to hog the limelight of late. Anything in that space that one of the stocks that got recently listed or via an IPO, or could be probably a demerger that could have happened, that you liked and you've told your clients that, okay, this looks good for a positional bet?
In fact, Darshan, we have been recommending Metropolis Healthcare for a long time, and I think this has been one of the IPOs which actually got initially listed near to its IPO price. But I think looking at the kind of business model and the kind of performance put up by the company, our sense is that this is a big market opportunity where the runway for growth is pretty large. And despite the fact that competition in the sector, especially from other players, has been increasing, I think if one looks at the business model for Metropolis, their B2C segment has been growing very strong. In fact, recently in Q2, they reported a 40% plus kind of growth. And our sense is that over the next, say, 2 to 3 years, despite the fact that competition is increasing, I think they have considerable brand equity, a brand pull, and that is definitely going to be important, because this is a business where quality and assurance is very important with the individual B2C customers. So we have been telling our clients to actually accumulate the stock. Any decline here could be a good opportunity to take a portfolio view on the stock for, say, a year or two.
What about valuations of Metropolis? It's no doubt not a cheap stock by any way. And if given a choice, would you stick with Metropolis or would you go with the leader, Dr. Lal, in this space?
I would still believe that, despite high valuations, Darshan, I think the risk reward and the growth opportunity is large. I think one definitely doesn't mind paying a high premium or a multiple for a company, provided, for the next 3 to 4 years. We believe that this opportunity is quite huge. In India, especially, lifestyle diseases have been increasing quite significantly. And looking at the kind of footprint Metropolis is putting in and the B2C kind of focus, I would believe that, maybe valuations may not be cheap, but then considering the fact that we're looking at the next 2 to 3 years, this definitely could give a decent risk reward. Dr. Lal Paths also is decent, but I think Metropolis is a recently listed opportunity, little less underpenetrated by the mutual funds and the HNI community, so we prefer Metropolis.
And just one more thing, given the fact that you think that unorganized to organized could be the big theme that you're betting on.
Exactly, I think that could be the big opportunity, and I think slowly we have been seeing that older pathology units which used to do it on a standalone basis, now they are gradually migrating to the organized players, especially Metropolis, which has now been very aggressive in converting most of these standalone units into their fold. So I think it's going to be a long opportunity. It may mean a little bit of hit on their margin front, but the volume opportunity and the business opportunity is pretty huge. So that way the runway looks pretty solid.
What about you, Shahina? Anything in the recent past that got listed, demerged, that you like for a potential long-term investment?
Disinvestment by the government, Mishra Dhatu.
Okay.
I believe there the potential is pretty big going forward, provided of course the company, the management is able to capture the opportunity being a PSU. But the thing is, the opportunity is very big, and if you saw the numbers also that they reported, we had a very strong profit growth of 75%, which was on a very strong turnover growth. Okay. But even if you look at the current size of revenues, like let us assume based on the quarter numbers, 170 crores, they are able to do somewhere close to 607 and 700 crores for the year, full year. The opportunity is there because the order book position is almost three times the current revenue. So I think there is no dearth in opportunity. There is exports that they are planning to tap, and the segment in which they are offers very good EBITDA margins. EBITDA margins in this segment can be close to 30 to 35% because in specialty steels. And the policies of the government for Make in India, for offset clause, basically which caters to the defense, which is where actually this company is spaced in, I think is very big, and the opportunity going forward is there. So I would tell a long-term investor to enter into the stock and hold it because valuations are also pretty reasonable.
What's the valuation on this counter?
I would say it's in about 17, 18 times. Yeah, so it's pretty decent.
And earnings were decent this time around.
Very good. In fact, not decent, they were very good. So and if you see, this is after a year of consolidation in terms both of stock price, in terms of profitability. I think if you saw FY19, it was more or less flat, stagnant. Maybe whatever, you can say the issue impact or whatever, but this year you're starting to see the momentum again pick up, and I do hope that for the full year they would do much better given the type of profit growth that they've shown in the first half, and there is no reason to believe that this could not continue going forward.
Okay, and that's Midani. What about you, Lancelot? Anything in the recent past that were listed?
I think Polycab is a company that offers some opportunity because, but like many of the IPO stocks, after the IPO they rally quite a bit. So I would advise that it's better to buy it, but on some declines. But if you look at the fundamentals of the business has grown even post the IPO. The quarterly numbers have been good, and this is in the background of a difficult economic situation, right? So we are not seeing the consumption side growth is slow. And despite all that, they have shown market share growth as well as growth in earnings. So as and when the recovery happens, I think you'll see a company like Polycab continuing to build out. Plus, it has built large capacity, so they have an operating leverage advantage because the capacity is always already in place. So when the demand picks up again, you'll see them being able to utilize it at a lower level. But one needs to be a little patient because the stock has run up quite a bit post IPO. So any correction can become.
I think despite the run-up, I think valuations compared to its peers like a Havells or something, still trades at a much cheaper discount to the.
Correct. So when you look at it compared to the peers, it definitely looks attractive. So which is why I said you can start accumulating or wait for corrections and keep buying.
So it's more like a slow compounder for you.
Sure.
For this thing. Okay. So those are the stocks that was spoken about in the first round, but we have a management waiting. It was a weak quarter for Pidilite with consumer and bazaar business seeing a degrowth in volumes. It also saw the slowest revenue growth in 2 years. Yash Upadhyay spoke to the company's executive director Apurva Parekh and began by asking him about the highlights of the quarter gone by. Let's listen into the interview.
During this quarter, the growth was moderated mainly due to challenging market condition, liquidity crunch, as well as prolonged monsoon. So these are some of the factors which resulted in our top line growth being moderated during the current quarter. As far as the operating margin goes, they were impacted due to the phasing of advertising and sales promotion expenditure. If you eliminate the impact of phasing of advertising and promotion expenditure, our EBITDA grew by around 13% during the quarter. On a positive note, the gross margin of the company expanded by almost 400 basis points. As far as consumer and bazaar product goes, the volume growth was around flat, while industrial product business, the volume grew by about 13%.
Okay. Well, I want to touch base with the gross margins. We've seen a substantial improvement over there, while because of the advertising and promotional expense, as you mentioned, has curtailed the EBITDA margins. There is comfort coming in as far as the raw material situation is concerned, and that is something that we have been seeing for the past 2 to 3 quarters now. Could you also help us understand that what has been the average VAM prices in the last quarter versus the corresponding quarter of the previous year?
The average, the price of VAM during last quarter was below 900, somewhere between $850 to $900. The same period last year, I don't have the exact figure, but, it was possibly about $1,100, $1,200.
Okay,
or possibly a bit more.
Okay, so that translates into a healthy 15-20% odd drop in VAM prices on a year-on-year basis. You also mentioned that you took some higher expenses in the second quarter, and that might definitely be a one-off for the company. And on an adjusted basis, there was a 13% growth on a year-on-year basis. Does this mean that there is scope for further margin improvement? Because clearly there is comfort as far as the VAM prices are concerned as well.
So we believe that currently the raw material prices continue to be benign, and hence that is favorable as far as gross margin goes. As far as advertising and sales promotion expenditure, it was more about phasing. During this quarter, we had a couple of large advertising campaigns which were not there in the same quarter last year. So, due to this phasing, the advertising and promotion expenditure was much higher in this quarter. The same will not continue in the remaining 2 quarters of the year. And hence we believe that that would control the growth of expenses as compared to the same period last year.
Okay, so while expenses would be controlled, another key function of margins is basically the share of the higher margin or the value-added products, and something that we've seen with some of the other players in the same industry as well. Take for example Asian Paints, their margins did take a hit, and some of the other paint companies as well, because generally in an overall situation of slowdown, we see consumers tend to downtrade in terms of product preferences. Are you seeing anything of that sort as far as Pidilite is concerned, or do you see the consistency in terms of demand to continue, and because of the factors that we mentioned earlier, margins should largely remain stable?
See, it is difficult to project margin because it depends on a number of factors, mainly the raw material cost and the foreign currency. We are not seeing any significant or material impact of down trading of our product. As far as our selling price goes, some of the reduction in raw material cost we have already passed on to the consumer, so that we have done. However, despite all this, our gross margin has significantly expanded, and if raw material prices continue to remain benign, our gross margin should continue to remain good.
So one more key area of your business, which is the industrial segment. Last quarter too, we saw a 14% growth year on year. This time around, we've seen strong 14% growth in revenues. Again, as you highlighted, even the volumes are on the higher side for the industrial segment. What has gone right as far as the industrial segment is concerned, and what are the factors at play here?
So in our industrial product, we have been very focused on our customer and product mix. During this quarter, we have seen a strong growth in our pigment business, both in domestic and international market, and that is one of the reason our growth rates have improved both in the last 2 quarters.
And is this something that you project for the upcoming quarters as well, as in for the second half of the year as well, this support coming in from the industrial segment?
See, I would not like to project about sales growth, about what will happen in the remaining 2 quarters, but we believe that the demand should continue to remain good for our industrial business, particularly our pigment business.
Okay, that was the management of Pidilite. So we spoke about the first stock, some of the recent stocks that got listed, counters like Metropolis was discussed here. Metropolis, you had Polycab, which was also discussed. So those are some of the stocks that you need to watch out for. The next stock we want to discuss is City Gas Distribution, and a lot of them have been focused. Gujarat Gas came out with a very strong set of numbers, the best among the lot. IGL has managed to rally because of not only the very strong numbers, but the inclusion in the MSCI. Mahanagar Gas, despite the volumes disappointing, the margins were extremely strong and did manage to rally 7-8%. So all of them have given very good returns. Of late, IGL obviously being the star performer, it's up almost to 56%. So we discussed City Gas as a theme. Is there any stock that Shahina you like in this space?
I'll go with Mahanagar Gas. While what I believe is that Gujarat Gas, of course, has definitely done well because of the change, the delta that has happened. Yeah. You had a lot of that Gujarat belt, Morbi belt converted their into gas. So I think that upside has reflected over here. But the stock, in my I like the stock, no doubt, but I think the stock has performed. So I would stick with Mahanagar Gas, which has been an underperformer in the overall space in terms of stock price. But there, I believe the opportunity is there, valuation is in their favor, and the reduction in gas price that we've seen in the last, it will be effect from October, I believe, October 1st. That will affect the second half to a small extent. I think Mahanagar Gas will be able to maintain its margins despite the 12% cut in gas prices. So I think in terms of valuation, in terms of opportunity, both from the CNG and PNG, I think it's there for Mahanagar Gas. So I would go with Mahanagar Gas at current levels.
What did you make of the numbers? The volumes growth was just 1%, which wasn't impressive. But overall, what did you make of the numbers?
I think the numbers were good. The margins were to an extent impacted, but volumes have remain pretty steady. So I think that will hold it instead, and I think the margins will be able to maintain whatever margins they have reported for the remaining part of the year. So I don't see any pressure on that front.
Okay, Lancelot, anything in the gas space that you like?
Well, I would like Indraprastha Gas.
Okay.
Mahanagar is also good, I believe. So, but I would think that Indraprastha Gas, while they had shown improvement in margins as well as volumes, the fact that they've also been allotted fresh gas supply, that also is positive for them. And I think on a longer term basis, you will see this company continuing to outperform it. They may not be impacted by negative events as much as the others who are a little weaker as far as their financials are concerned. So yes, you are paying a premium for the quality, but if one has to buy into this sector, while this is not the best time to buy it, one needs to wait for a decline and then buy into it, because it's more like a compounding return kind of situation. But if one has to choose right now, then I would really look at Indraprastha Gas at this point in time.
Okay, Indraprastha Gas over MGL at this point of time. Any word on Gujarat Gas? Do you track that?
No, I don't track it as much.
Okay, Avinash, among the three large city gas distribution companies,
No, I think
there's Adani also probably. If you
I think within the gas players, I think both Mahanagar Gas and IGL look to be the well positioned ones. In terms of the kind of debt Gujarat Gas or Adani Gas carries, I would believe that clearly Mahanagar Gas has definitely potential for growth in markets like Mumbai and Raigad, which we believe have got a lot of under penetration even as of now. And despite the fact that volume growth was disappointing, I think the residential PNG segment reported a decent growth. So I think hopefully once the volume growth picks up, you could definitely find Mahanagar Gas also getting re-rated. But overall, I think these are companies, Darshan, where you need to take a 2 to 3 year call. Clearly, in terms of their balance sheet and in terms of the opportunity for natural gas, I won't be surprised that despite premium valuations, investors who can wait for a longer term kind of time frame here can definitely make money.
You think one of the overhangs that MGL always had was the BG gas selling?
Exactly.
Is that over for them, or?
Yeah, I think now that is over. I think now the market should obviously be looking at what kind of volume growth the company could record. I think that has been a major disappointment for the last 2 quarters, and I think the management has also been putting up a very strong kind of show, saying that volume growth could pick up from the industrial segment, possibly from the second half. Our sense is that maybe from the 4th quarter of FY20 and FY21 could be a lot better, and once volume growth comes to the normal range of around 7-8%, I think you definitely could see a good re-rating here.
Okay, that's the view that's coming in. Counters like IGL, Gujarat Gas, MGL, all of them we were being discussed, and remember, all of them have managed to outperform of late, and all of them have come out with very strong set of numbers. Again, now we want to speak about some of the stocks which have been beaten down significantly. Obviously, when something goes down, everything goes down along with it, be it fundamental reasons or non-fundamental reasons. But there are some stocks which have fallen significantly, 20, 30, 40, 50%, which still carry value for a long-term perspective. Lancelot, anything that which has fallen significantly and now you believe this is the right time to start accumulating?
I would think IDFC Bank is actually a good company. Especially post the merger with First Capital, the quarterly numbers came out, and we've seen an improvement in the CASA that they've done. You're also seeing steps being put in, to sort of degrow the infrastructure lending piece, which was one of the drags in the bank earlier. So I think there are a lot of positives that have happened in the bank, but it's yet not reflected in the share price. So this is probably a time when one can accumulate this stock, because it's been trading in this range like 40, 42 for a long time now. And if one accumulates it, waits for the effects of the steps being taken to show up in the financials, I think that's the time when you would get very good returns from this.
One concern I think which people had, no doubt the numbers were good, at least on the NII front, and the asset quality seems to be that didn't go all well it did rally after the results, but asset quality still remains a concern. Do you think that the management has the bandwidth as compared to the larger banks to clear off their asset quality issues?
Yeah, so if you look at the asset quality issue, it's mostly the legacy issues. It's not really new. It's not the retail lending which is seeing stress. It is mostly the old infrastructure and the corporate side which they had, the corporate book which was there from the demerged IDFC piece that was left in the bank, and that is seeing some stress. So that is like something which you won't see an increase in that asset quality, because if you take the total assets that are there, they are already reducing the proportion of assets. So over a period of time there will be some recoveries on that front, but you're not seeing stressed assets grow, because the bank's strategy is not to increase that kind of exposure on that book. So I think that will get taken care of within a period of time.
Now, are you confident of the management? Because Vaidyanathan did extremely well with the NBFC, but running a bank is a totally different ballgame. You think he will be able to turn around? Because what we've seen is for banks, I think a lot depends on the management, and the way the share price move is dependent totally on who leads the bank. You think Vaidyanathan is up to it?
So I would say that Vaidyanathan not only ran the NBFC, before that you must not forget that he was also with ICICI Bank, and he was one of the key guys who built out the retail franchise in ICICI Bank. So I wouldn't say that he doesn't have experience to run a bank, and hence plus he's not that he's the only person. You have a team of people there who are experienced bankers who have also joined him, and I think the team there is fairly well qualified in terms of being able to run and manage a bank. So from that perspective, I don't see that really as a big concern.
Okay, that's the first stock, IDFC First Bank. The counter is flat in today's trade. What about you, Shahina? Anything that you've told your clients to accumulate recently?
Yeah, I personally also have, and I do recommend that one takes a contra call on Yes Bank. Though of course it has gone up a lot from its low in the recent past. But if you see after the second quarter in the con call, the book value has been put at 109 rupees. Even if you were to adjust, let us say the retail book is 25,000 crores, the real estate book is 25,000 crores, you adjust for that, you adjust for other non-performing assets, still I believe the book value, adjusted book value, is close to the current levels. Now the upside where I see from here is we are having a lot of interest coming in from various groups, large groups, strong groups, to participate and co-promote, become promoters in the bank. What happens, and when that happens, I believe the book value will automatically go up to about 1995, where then that opportunity rises to make money from current levels. Of course, it is a slightly riskier bet given the quality of assets that they have as of now, but I think one can take that bet.
Okay. And you think that they will be able to come out, because while they said that there is $1.2 billion of funding that will come in, they didn't disclose who. There were obviously a lot of rumors doing around who that could be. But see the second quarter number, the asset quality again moved up to levels of I think 7%. Is that a concern that you have the core fundamental working of the bank?
Yeah, I think the quality of assets is a concern, and that is the biggest concern because the bank per se is pretty strong in terms of the technology. It's known as a high technology bank. They have got interest which is not only from the one that was being mentioned, which was again positive or negative because we didn't get clarity on that, but we keep hearing developments of say 10% equity interest from a smaller number from strong groups. So I think small business houses. So I think if that happens, the bank, which is anyway strong in the corporate sector, could really do well in terms of performance. Could bounce back from current levels. But the cleanup of books, I think there is still some time and it will continue. So that is why I'm saying the book value, where any which ways the current price is any which ways at a very, I think it's 0.5 6.5 or something, right? If you're calculating it. So it's basically factoring in the poor quality of book.
Okay, and Avinash, which is the stock that you believe?
Darshan, we have been liking the auto component sector, and I think, considering the downturn in the sector as of now, we like a company called Swaraj Engines.
Okay.
Now, this is a very interesting company. In the last 4 to 5 years, whatever capacity has been put up has completely come from internal accruals. They are completely debt free, and it's one of those rare companies, where possibly we could see, ROEs and return on capital employed levels of almost 35 to 40%. So I think, once the cycle turns for the tractor business, I would not be surprised that there could be a significant re-rating. In fact, in terms of payouts, they pay very healthy payouts of almost 500% kind of dividends to shareholders. So clearly, from a longer term perspective, the downturn in the industry has affected the company. This could be a good time to accumulate the stock, and obviously over the next, say, 18 to 24 months, hopefully the cycle turns for tractors. You could definitely see a very good risk reward.
Okay, that's the view that's coming in on Swaraj Engines. And the final stock that we want to speak about is UPL. Now, one company which came out with a poor set of numbers, and the counter has been correcting. I don't know what it's doing today. Again, it's down by another 1%. So obviously concerns remain on the counter. Avinash, what did you make of the numbers? Are you concerned about how the financials panned out for UPL in Q2?
I think numbers were definitely quite disappointing, and I think the kind of commentary and the kind of signal which the numbers gave in was very clear that possibly the third and the fourth quarter could be equally challenging. I think demand conditions across the geographies has been hit, and added to that, the Arista acquisition which they acquired has been largely funded by debt. Although the management has sounded that they would be looking at reducing debt progressively over the next, say, 18 to 24 months. Our sense is that in the near term, hopefully if demand doesn't pick up, and there are some currency issues, and obviously the debt on the balance sheet is pretty large, till that time I would believe that the stock could remain a little bit under the cloud, and possibly we could see a little bit of underperformance. So as of now, I would not buy it. Better to wait for some more clarity to come.
Are you concerned about UPL and the financials that came out?
Yeah, I think so, and I would also avoid any investment in the stock at current levels also, despite the huge fall. I believe the huge debt that lies on the book is a concern, and while the last quarter that we saw, the last first half has been impacted because of one-time write-offs, I think there is definite concern on the EBITDA margins. So while revenue has been decent in terms of the top-line growth, I think this is going to eat into the EBITDA margin decline is going to eat into the profits for the full year. The commentary of the management also says that. So I think it's better to avoid it at current levels. It's expensive stock also. It's not cheap.
Okay. What about you, Lancelot? Any word on UPL?
Yeah, I think, like everyone says, the debt seems to be a little elevated, and that is something that has been factoring on the stock. And also what we are seeing is, there are more frequent disruptions because of weather, etc., which have made the predictability of UPL's earnings sort of get impacted. Like UPL was a company which, because of its diversified portfolio and the risk getting spread across different geographies, they would continue to show earnings growth irrespective of what happens in India or what happens in Brazil, etc. But now, because of global weather conditions, changing so rapidly, we are seeing disruptions at all places, and that is impacting their ability to be able to generate earnings consistently. So I think the kind of re-rating that had happened in the stock, where it was re-rated as a compounding company that constantly compounds, that has now taken a beating, and it may re-rate for volatility. So given that background, yes, while the longer term outlook will be good, the volatility in earnings is also going to give opportunity to buy at maybe discounted rates at lower levels.
Okay, that's the view that's coming in on UPL. Again, concerns remain on the financials, and the second quarter numbers were a shocker from UPL that came out. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests who've come in, Lancelot, Shahina and Avinash. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.